for any crisis, we would like to understand the root cause, and that's where the solution comes from, right? So I would like to introduce you to Ms. Arushi Saxena, who is also our Director of Business Administration, to see from where it all began.
Thank you so much, Shreya. And indeed, sir, thank you so much for shedding light on the crisis. So, as Shreya rightly gave the introduction, where did all of this begin? What happened? So, to deep dive, we can see that what is global economies? The Oxford Dictionary defines global economies as the economies of the world's individual countries considered together as a single economic system. For a better understanding, imagine that the global economies are like a tall tower of Jenga, with each country's economy contributing towards ensuring the overall stability of the tower. The recent financial turmoil and collapse of historic financial institutions have affected the stability of this tower. So let's take a deep dive into the core factors which affected the global economies and their reactions. Factor one, COVID 19 impacts, as they all say. A pandemic in all senses, COVID 19 wreaked havoc, not just from the health and well being point of view, but also from the economic and financial perspectives. It was reported by the IMF that the global annual GDP growth rate dropped by 3.5% in the year 2020 when the pandemic had its peak. This growth prompted countries to introduce unplanned policy stimuli to support their citizens. However, the ripples of the suddenness are still being felt as seen through the recent banking crisis. During the pandemic era, when most companies had to halt their operations, tech and virtual services related companies faced a surge in demand. Through the emergency fiscal and monetary policies introduced by countries to provide aid to their citizens, people gained access to more disposable income, which was utilized to purchase virtual and tech related products. As they say, after dusk comes the dawn. The dark pandemics came to an end and people resumed their pre pandemic routines. The only difference is more disposable income, leading to increased demand for commodities and hence greatly pushing inflation. In the US, among other countries, the increase in inflationary pressure was so high that the Federal Reserve had to increase interest rates in order to restrict the money supply in the economy. Adding on to this pressure, the emergency policies introduced by the US Federal Reserve brought with it a major increase in fiscal deficits and government debt ratio. Second factor, US Federal Reserve strategies, as covered previously. With a GDP of about $20 trillion, the USA is by far the world's largest economy, making it one of the biggest influencers for ensuring stability in global economics. It is upon the Federal Reserve of the United States to make calculated decisions to ensure the good standing of its country's economy. The recent collapse of major banks has not painted a good picture for the hawk eyed investors. They have pivoted from worrying about inflation and interest rates increase to focusing on how problems with banks damage the economy. In addition to changes in policies, the Fed is also facing scrutiny for its oversight of the two failed banks' risk management practices years ago, which were not corrected in time. As the recent development suggests, the only way out would be to introduce tighter conditions for credit availability while tackling inflation, subsequently stabilizing the economy and its financial institutions. Now let's turn an eye towards the global picture. And the third piece of the Jenga puzzle, Russia-Ukraine war. Now the other piece of the Jenga puzzle, as we discussed, is that which can lead to the collapse of our Jenga tower, is the Russia-Ukraine war. The recently acquired Credit Suisse warned that the combination of the current geopolitical situation following Russia's invasion of Ukraine and the significant monetary tightening initiated by several of the major central banks in response to this inflation concerns have highlighted a heightened volatility and client risk aversion so far this year. This risk aversion showcased by investors can be seen particularly in the European banking stocks, which were negatively impacted with banks from Italy and France most exposed to Russia, together accounting for more than 40% of the total exposure of foreign banks in Russia at 25.3 billion US dollars and 25.2 billion US dollars respectively. Banks with large Eastern European activities also saw a decline in stock prices. Credit Suisse was among the major institutions which faced a brutal financial hit from Russia's invasion of Ukraine. The related losses of the bank amounted to 206 million Swiss francs, equivalent to 214 million US dollars in the period from the first quarter of 2023. It was not just the banks, even the equity and bond markets have been significantly volatile. The impact of these geopolitical tensions demonstrate how uncertain the current environment is in which financial companies operate. David Vandenberg, global head of financial institution at Alliance Global, commented. It is only with time can we witness a resolution to this challenge. In the meantime, let's explore the more unstable pieces of our Jenga tower, the artificial market bubble. There was a misconception clouding everyone's vision about the reversal of emergency policies and restoration of global economies after COVID 19. The market experienced somewhat of a bubble in the fact that global economies, especially in Europe, felt that a rapid increase in interest rates would allow the tackling of rising inflation while stabilizing the post pandemic world operations. However, this bubble burst when Deutsche Bundesbank, the central bank of Germany, on 9th May 2023 reported that the European Central Bank would be increasing the interest rates further. And by 26th May 2023, Germany announced its negative GDP growth and the onset of recession. The persistence of high price increases continued to be a burden on the German economy at the start of the year, the Federal Statistics Agency, the Status, said in a statement. The has predicted that Germany will be the weakest of the world's advanced economies, shrinking to 0.1% this year. Deutsche Bank, the largest bank in Germany, reported financial distress as its stock prices dropped more than 14% on the Frankfurt Stock Exchange, resulting in a depletion of its money reserves. The bank's long standing operations have made it a global institute monitored by international rules, requiring it to hold high levels of capital reserves, failure to meet which would result in widespread losses. But thankfully, the recession seems to be less severe than some had predicted, given Germany's heavy reliance on Russian energy. A mild winter and the reopening of China's economy helped ease the impact of higher energy prices, among others. Now, let's draw a comparative analysis of what's going on. One side is bad, but are there any goods to this? The good thing about having a diverse range of countries is that, on the one hand, some countries seem to be suffering due to uncertainties, while some others are rising above it and showing a relatively positive result. Case in point, economies of Japan and Singapore. The Japanese policymakers have so far stuck to the view that the possibility of another financial crisis is low. Safeguarding its economy is the country's reliance on solidifying its position as a large-scale exporter of key products, ensuring a steady flow of income, while also having multilateral currency swap arrangements with Southeast Asian economies to prepare for crises like the one they faced in 1997-98, the Asian currency crisis. Another Asian country that has been outperforming its peers is Singapore. The country's economy expanded by 0.4% in the first quarter of 2023 compared to the previous year. The Trade Ministry aims at maintaining its GDP growth forecast at 0.5% to 2.5% this year, with growth likely to come in at around midpoint of the range. The numbers seem to forecast a rosy picture for the country's economy. However, nothing can be said about the future. Gabriel Lim, Permanent Secretary for Singapore's Ministry of Trade and Industry, commented that Singapore's economy is still sensitive to global trends that include the impact of recent banking stresses abroad on global financial conditions, as well as risk of escalations in the war in Ukraine and heightened geopolitical tensions among major global powers, which can influence its growth. Well, only time can tell whether policymakers are able to successfully stabilize this game of Jenga or a collapse is in the cooking. What do you think?